Hi there, traders. This is Brad Gilbert with the Daily Market Insight for Thursday, the 2nd of November. All right, now the dollar tracks Treasury yields lower. Fed stays on hold. Right now, there's a couple of key things here that came out of the Fed meeting. Basically, and the assumption is by most participants that the Fed have done with their aggressive rate hiking scenario. Now, the couple of things to follow up with that. There was some news out that let me just get that pen back up. Okay, thanks, Mo, for posting this. The US Treasury slows pace of auction, increases for long-dated debt, right? So basically, this is it's almost like subtle intervention in the market, but they've raised enough cash, less auctions. Basically, the prices will go up, yields will fall, and that's what we're sort of getting on the board here, right? So that could be the, from here, we should probably see the US bond yields start to drift lower. And on top of that, with everything else that's going around, if you look at the news, let me just clear that, sort of the data yesterday, ISM manufacturing numbers there as well, reasonably weaker than what was forecast at 49. And the ISM manufacturing employment numbers also weaker. So you know what? Some of the US numbers rolling over. The Fed can see the writing on the wall. The supply of these bonds, right? Subtle intervention, yields will go down, and we're starting to see the dollar already fall, right? I think this move, right, is a little bit muted. If I can just take my pen back onto the browser. I think these moves are somewhat muted already, as in like there's more to come, I should say. Let me just correct that. So, but just having a look at the charts, right? And if I just get these up, just looking at the currencies, right? The dollar's sort of just drifted down now. The whole aim of them talking about the bond market is to take the steam out of the higher interest rate sort of environment, right? That has been around for some time. So you are starting to see the dollar fall. What they don't want to see it fall dramatically, right? That's not what they're trying to do. They're trying to just let us know this is more like the top. So, and with that, right, you see the Aussie Kiwi in particular really start to rally. Euro and Kiwi pretty muted, but I think they'll pick up as we go along. Now, the key part to that is the top of the US interest rate hiking cycle. It creates a great environment for obviously equity markets, which rallied aggressively, and I think they will continue to rally. This is the risk on scenario, right? That's what I was just highlighting. Aussie Kiwi. You think CAD would as well, but CAD's got its hands full managing, what's going on with oil there as well. Okay, so the dollar index back in the range. If anything, I think there's a chance we could see it lower. Euro back in the range. You'd be redrawing those trend lines, and I'll be looking for a higher euro if we get some sort of joy out of some of the ECB numbers. At this stage, it's like there just doesn't seem to be any positive side of things out of the Eurozone. Gold just drifting sideways and oil falling, right? That's going to stop dollar CAD sort of going back down at this point. So, like, what do we got? The key thing is here is just sort of recognizing and let it sink in. Like I was just saying on the Discord there before, right? When I just get that up, now a lot of the situations, especially around bond activity, right, from the central banks, it's not about like we're intervening in the market and this is what's going to change. It's a slow, gradual shift, right? And it will definitely like pop the balloon as such in the bond market. So the yields will sort of drift lower, but it's not an immediate, okay, like sell dollars, crush everything. They don't want that. That's not the whole aim of this. But what you want to be watching as we go through the next few sessions, so I'm just losing track of where my pen is. What we've got to be looking for is a bigger move here, right? Like a confirmation. And how is this going to happen? Well, the good thing is, right, as I was saying at the start of the week, we've got a very active week here, right? There's big data across the board. Now, today's no different. We have, there's a bunch of Swiss inflation numbers, right? Great time for some strong numbers here, but I don't think we'll get them. But you know what? Good time for basically strong numbers anywhere outside of the US, okay? German numbers, the Eurozone, even the Bank of England, right? No change of rates expected. We probably see something similar to what the Bank of, or the Fed have done, I should say. And then we come in down the bottom here, let me just scroll that up, is a bunch of US numbers. Now, we could see some numbers roll over here, and it would really support exactly what the Fed has done, especially the weekly jobless claims numbers. Keep an eye on those. And there's no real sort of massive correlation between the non-farm productivity and the non-farm payrolls, which are coming out Friday. But just have a look at the factory orders here as well. Like, we get weakness in these numbers. It really confirms the weak dollar sentiment and rolls us into a negative tone for the non-farm payrolls on Friday. Okay, so to me, the market, and I've been doing this a long time. To me, the market will be really looking for the nail in the coffin, right? And what I'm talking about is something they can rip their teeth into. Really start buying equities aggressively. Really sell the dollar aggressively, and buy euro, sterling, Aussie, Kiwi. Right? This is a classic risk-on environment. The prices here going up, exactly what the Fed has signaled. The yields are going down, right? And this, as I said, it's not like just a one-off situation. This is the tone. Get ready. I think we're going to see a weak dollar. And if we get weaker numbers, it's going to start pretty quick. It's almost a shame that the non-farm payrolls aren't coming out today, because it's right on the heels of the Fed meeting. You get that weak dollar sentiment. All we would need is weaker US employment numbers. Boom. And the whole scenario changes. And then when you look at the charts, you'd be looking across the board here, trying to identify opportunities that you can get into where a weak US dollar comes into play, right? You want to be this is the main reason you want to be going through your charts and redrawing the various trend lines, etc., because this is a new game. This is the way you should be thinking of it. The game has changed. The dollar, to me, is on its heels, and we're looking to sort of give it a bit of a knockout punch. So go through your charts, just like I'm doing here, and tune them up, right? If anything, dollar Swiss looks like it's already started to break down. It's been the leading, out of all the instruments, actually, it's been one of the leading instruments of the dollar moves, right? Obviously, dollar yen. Well, actually, funnily enough, this is a good point. I'm glad I'm sort of going through this, because now the Fed has told us what they're doing as far as bond yields going down, weak dollar sentiment. This is a time that the BOJ could strike, right? I don't think they will right now, but I tell you what, this is the environment, right? Once the Fed have put this out in the market, if the fundamentals start to shift, it will be confirmed that the weak dollar's in play. That's the time the BOJ can strike and really get value for their buck. As I said, dollar CAD still going topside, right? Oil falling, that keeps driving it up. But on these other instruments, right, you're looking for opportunities here. To me, I'm really focusing on, the weak dollar prospects. Euro, sterling, Aussie's already sort of jumped up here. And you can see this massive reaction here on the Kiwi. If I could just get that back up. Let me just clear that screen, because the Kiwi, it's been under huge pressure, right? And, we saw those weak Kiwi numbers, and then all of a sudden, right, you see how much pressure there is on the downside here, and we see that dollar sentiment turn around. I know it's a risk-on sentiment where you've got the equity markets rallying and the risk currencies, Aussie, Kiwi, CAD not so much, but we are looking for opportunities here. And to me, dollar index on the downside, euro topside, sterling topside, even dollar Swissy retracing here. And Aussie and Kiwi have already gone, but this is where the individual data can come into play and give you opportunities to get into some of these trading events, right? So what I'm talking about is, if you don't have technical levels, you're looking for momentum and price action to get in. And that's what the fundamental numbers give us. Now, just be aware, the Bank of England, it's not going to be easy, right? Depending on what they're talking about as far as interest rates. No change expected, as I said. The sterling is starting to bounce. What happens on sterling will really depend on the statement and the press conference from these guys, right? So that could be a little bit tricky. Sterling, just be aware of that. But you know what? Any sort of positive numbers out of Europe, it'll be an excuse to buy euro, sell dollars. And that's what I'm looking forward to as we go into Friday non-farm payrolls. All right, guys, so that's it for me just for the moment. As I said, just to repeat, risk-on environment, euro, sterling, Aussie, Kiwi up, the dollar down, just about most pairs, bond yields down, right? This this perfectly lines up and makes complete sense. And I love it when it does that, right? So good luck. All the best. Cheerio.